the inflation around the world is going to continue to buoy inflation in the US, even if we get our house in order.
It's the whole consumer cycle, the consumer credit cycle. That doesn't look good, to be honest. And so I think the fall is going to be complicated.
Shomara, has the soft landing been secured?
I mean, it's pretty incredible, actually, but it looks like there's a really good chance that it has. I think the bigger question, though, is if we are on the verge of a real contraction in the economy. And I think there's been enough people that have warned. You have to remember, even though the stock market for 7 companies is hitting all-time highs, the stock market for every other company that isn't those 7 companies have not. And that really is about just the broad-based demand in the economy. So yeah, I think that inflation is contracting, but it could be contracting for a combination of reasons. One is because we have had high rates for a long time, but the other part is now people are unemployed, there is no money. And the question is whether you have some sort of contraction economically that is measured by a recession or not. I think that's a really big question. What happens in the next couple of quarters? Do we have a little mini recession or not?
I think the market's priced in a lot of the expectation already. If you look at the PE chart on the S&P 500 going back 5 years, you can see that we peaked out, obviously, in 2020, 2021, where we had a big boom with all the stimulus money coming in and all the money found its way into the markets during the end of the ZIRP era. And then there was the slow wind down as we started to hike rates, and then rate hikes peaked. And now, despite the fact that rate hikes have stopped and there have been conversations about market valuations, we have still seen a rather significant increase in the PE ratio across the S&P 500. Now, to Jamal's point, a large percentage of that is contributed to by the top 7 tech companies that are driving that ratio inflation. But a lot of the market makers have already started to take action, expecting the rate cuts to come in at 90% plus likelihood of rate cuts happening this year. So I don't know how much market action we will see, but there has been a lot of conversation from DC about the Fed should reset expectations on inflation from 2 to 3%. And if they did that, that becomes the new normal. And we're never going to get back to 2%, at least in this current kind of era. The Jerome Powell mandate of 2% inflation may be an expectation that cannot be met given the amount of stimulus that went into the economy during COVID, that it could take a decade to earn its way out. As a result, we will not see a normalized contraction of that capital coming out of the markets in a way that will get us back down to 2% inflation for the time being. And I just saw a presentation by a bunch of food company executives recently, and they took 13 to 15% price hikes last year. But the reality is that inflation is not just in the US, but around the world, and it affects the US markets as well, because a lot of US companies have had to raise prices because of their dependence on labor and materials and commodities from other countries that are inflating. And because of the way that the globalized economy works today, the inflation around the world is going to continue to buoy inflation in the US, even if we get our house in order. It's very unlikely that we get back to a 2-handle, at least in this kind of era. And as a result, you'll probably see the market kind of assume that we're going to be at a 3% kind of inflation level for quite some time.
It's very interesting, the obsession with the 2. The 2% handle and this target came from the Reserve Bank of New Zealand, this guy, Roger Douglas, Minister of Finance. And he came up with it because they just asked him, well, what's a healthy one? And he came up with that, and then everybody adopted it.
The Fed's mistake was just waiting way too long to react to the inflation. And they didn't just wait 9 months after the first inflation print came in that was too high before they started raising rates. They continued QE for 6 more months. So when you talk about all this stimulus that's still in the economy that they can't seem to get rid of, a lot of that was created by the Fed's QE in the second half of 2021. That should never have happened. Since then, they did what they had to do, which is they increased rates to solve inflation. That's what you do. And yes, it does seem to be working, but we still have inflation being persistently high at 3%. And so now, like Freeberg's saying, they're trying to change the goalpost to somehow normalize 3%. We should just understand that what that means is permanently higher interest rates, because the Fed has to offer, under normal circumstances, has to offer a return above the rate of inflation. So whatever that return is, 1%, 2%, you stack that on top of the inflation rate. So in other words, let's say the Fed wanted to target a 2% real return. That means that the interest rate would be 5% with the 3% rate of inflation. Whereas if inflation can be managed down to 2%, you would have a 4% interest rate. And that persistently, if we're talking permanently higher interest rate, will create a drag on the economy, because lower interest rates create more investment. They reduce the hurdle rates to take risk. Whereas higher interest rates, as we've seen, create drag on equities and drag on investments. So if they redefine the inflation rate to 3 instead of 2, there will be long-term consequences from that. That is not a free thing to do.
Yeah.
So that would be like one part of the answer. The other thing is just, look, inflation going from 3.1 to 3.0 is positive. It's good news. better than it going from 3.1 to 3.2, but we're talking about 0.1%. And I just think people get a little too excited reading into these prints when these are not huge changes in numbers. I do think that once the inflation rate starts with a 2 handle, that psychologically, I think will be a big change for people.
Psychology has so much to do with this. I was doing a little research on it, why it's so contentious and there's so much of a lack of consensus about it. This is basically a psychological phenomenon called partisan economic perception. And this has been studied for some time. And what's really interesting about it is it shows what percentage of people who are Democrats and Republicans here in the United States of America say the economy is good. And if you look at Clinton, and, he got to be president at the helm during the internet revolution and this incredible economic boom. He was obviously so centrist, right? He appealed to both sides of the aisle. And you had this very tight consensus that the economy was good. Democrats were maybe 3 or 4 percentage points above Republicans in that perception. And then Bush came in, and all of a sudden, Democrats hated Bush so much that they perceived the same economy. 2000, obviously have the dot-com bust there. So they both went down in unison, especially after the Great Recession. But you have this disparity that comes up, Chamath, where you have 25 points between how they perceive it. Obama, obviously, Democrats were incredibly enthusiastic about Obama, effusive even, but Republicans hated him with a passion, right? I mean, that was really when Fox News started to get cooking. And then you look at Trump, same exact phenomenon. It flips. Under Trump, 80% of Republicans think, the economy is good. And then Democrats say it's not good. And that plummets and you get this big dispersion. There are 2 moments in time, Freeberg, or 3, when you start to see the consensus get tighter, and that's during a crash. So there's a dot-com crash, great
and an election.
Financial crisis, and an election, and that's a very good point, actually. I didn't notice that. And then also during the pandemic. So you have 3.
Yeah, this is a great chart.
Looking at this, I think it explains so much of the tension in the country that we can't even agree on, hey, is the economy good? Everything is perceived through your partisan lens. What's your takeaway from this?
At the end of the day, if people feel like they're progressing, they feel happier. They feel like they're not progressing, they're unhappy, regardless of their absolute state. I think that there's some studies that show that if income growth is not roughly 10% a year, you get an unhappiness indicator. And then there are other associations with that. Like, am I improving the size of my house? Am I able to buy a new car? Am I able to progress in my career and make more money? All these factors kind of play in. And much of this ends up being buoyed by the political ideology of the candidate that's in the office and how they are popularizing what they are doing to help you progress, even if you are or are not actually progressing. So then people hear the political leadership say, this is what we're doing. You associate that as being positive or negative. If you're a Republican or you're a Democrat, you associate it as one or the other. And so you have this perception of progression without actually having economic progression be tied to it. So the reality is it gets decoupled. Much of the inflation, I think grocery prices are up 30+%. The more globalized the businesses are that are providing the goods or services to us, the more likely they are to need to hike prices to make up for the inflationary cost structure in their business because of their global presence.
Found this video insightful? Hit subscribe, turn the bell on, smash that thumbs up, and dive into the links in the description below. Join our vibrant community to ensure you never miss a video. Your generous support fuels our passion. Thank you for watching. We love you.